Record, and it's being recorded. Can everybody hear me okay?
Yes.
All right,
Yes.
perfect. Awesome. Well, again, thanks everybody for jumping on the call. Really excited to continue to build our investor community. Really, our vision is to help really provide and facilitate legacy wealth, which means that you're passing down more than just financial, but also values, and skill sets, mindsets, and so many things to be able to truly make the world a better place. How we do that is through helping with connecting to investment opportunities, to really with the goal of $1 billion dollars made for other people. Within the investing ecosystem, there's a number of different strategies. And so one of the things I want to continue to do is one, teach on investing through real estate funds, private equity funds, and alternatives of really partnering the money that we have with people who have already learned it. And then also looking at, hey, as people who are W-2 earners or business owners or different things, how do we also utilize some of the tax strategies here? So today we're going to be talking about unlocking tax-free wealth through charitable LLCs. So really excited to have Greg. So Greg, thank you so much for jumping on. I'm going to give a quick, I'm actually going to read this off because Greg's such a powerhouse that he's got a number of different things. So I don't want to miss anything. So Greg has over 20 years of experience in wealth, estate, and charitable planning for multi-million dollar net worth clients. Greg also has a strong knowledge of insurance and securities, which brings a balanced product knowledge to his clients and plans and portfolios. And he's familiar with a number of different specialized financial tools, and how they integrate to meet his clients' goals. So before opening his own practice, he worked at firms specializing in high net worth individuals and business owners, which provided him with a really extensive knowledge of different things. And that's one of the things that I really want to provide is like some of these strategies are being utilized by high net worth people, family offices, but I like to call us like our everyday accredited investor. We're like this middle gap between these high net worth people. We're on our way to continue to grow wealth there. And so we want to be utilizing some of these strategies so that we can fast track what we're doing in that way. So, Greg, thanks for jumping on. Anything I missed in your bio, anything you want to introduce yourself before we jump into what a charitable LLC is?
Um, no, I mean that bio I wrote years ago, so it's probably closer to 30 years, but I don't count the first 10 because I didn't know what I was doing the
There we
first 10
go.
years of being in the business. So I kind of discount that as irrelevant and in the past. So
Right. That's where kind of the learning happens. And that's one of the reasons that we only partner with people who have already been executing a formula because we want to not be a part of the school fees. School fees are, the education by doing. So uh awesome. Well, appreciate that. So can you tell us, and so one of the, just to preface all of this is I'm continuing to connect and look for different ways to be able to invest a lump sum, right? So when we invest in syndications and funds, we're looking at 50, $100,000, 200 up. And so are there, and a question I get is, hey, should I invest this from my individual or like from my personal account, or should I have an LLC? Should I create a trust? Should I do it from a 401k to an IRA? Those are a number of different questions we're not going to dive into right now. But what we are is we're going to dive into the formula of utilizing what is called a charitable LLC. So, can you tell us a little bit what a charitable LLC is?
yeah, so I mean, to be honest, charitable LLC is just a marketing term we use, but there's a lot of people out there doing. I don't say a lot. There's not that many people, but there are people out there doing things and they call them charitable LLCs. Mark Zuckerberg did one, I don't know, maybe 8 or 9 years ago now. His is very different, but it's really just we set up a business and instead of using a trust vehicle, we use a business vehicle. It allows us to operate a little more freely, gives a lot more flexibility, but it's an LLC that's there for charitable giving and for tax planning. So it helps us use it for tax planning. So the way we do it is we have an LLC that's owned by a charity that we then use for our clients. And we set up different new ones for each client that they get to manage and decide how to invest the funds in it, but they get a tax deduction for putting the money into it. And that's the way we utilize Charitable LLC. There's a lot of flexibility, a lot of different ways to do it. Some are good, some are bad. It's very easy to abuse. So we want to make sure we're doing it right and we're using the right clients for this. It's not just for tax planning. It's because we are philanthropic and want to give away. But we can put in a couple $100,000 a year into this or more or less. And the amount we have to give away from it, we'll get into that a little probably, but is small. It's up to the client how much they want to give away, but it's not like we have to put in $200,000 and then give it all away to charity and it's gone. So it allows the clients to use those funds for investment opportunities, whatever they are, to do so. So
So
now my
let's use,
background a little bit, my background, so I'm a financial planner technically. I don't manage any money. I don't sell any products. I don't sell insurance anymore. I stopped doing that 30 years ago. Well, 25 years ago, probably. Uh, this is what I do. We specialize in tax planning. We specialize really in charitable tax planning. We might have one client a year that we're not talking about taxes. So almost everything we're talking about taxes, almost everybody we're talking about charitable planning tools. So we'll look at everything with our clients to figure out, like you were talking about, Daniel, to figure out the best way to do what they want to accomplish. Obviously, you guys have a different perspective you're coming at it from, but we're going to look and see what options are available, whether it's 401k IRAs. There's ways to do almost anything. We're trying to find the best way to do it for keeping things clean and smooth and making it easy, but also staying compliant and legal and matching the client's goals and values with the right opportunity. So obviously here we're talking about Charitable LLC, which is again what we use most of the time because it is the most flexible and it gives the client, I don't want to say ownership, but it gives them more control over what they're doing.
yeah. So to reiterate that, so let's use an example. Let's say I have $100,000 and one of the formulas that I talk about is, hey, because a lot of what we talk about is investing here is, okay, well, I want to put that amount into, let's say, a fund. So I'm looking at different ways to be able to do that. That being said, I will say some people, like you said, are utilizing these for different things. It doesn't necessarily need to be for of where what they're doing to build wealth with that. We'll use for this example 100,000. So you create an LLC that is managed. I have 100% or not 100%, but like a control over it. And then, but it's actually owned by the 501c3, the nonprofit, which then makes it a charity. So the
Right. So
unique
what,
dynamic there is, and this is where, and we'll all jump into risks in a little bit, that technically you don't own it, but you have all of the managing. So, and it was interesting before I ask a little bit of how that structure works. I have a friend who's a banker, and he talked about how these two guys were co-founders. And one guy actually had 100% equity, and everything else was written in their agreements. And so they were 50-50 partners, but one was 100% equity. So there are ways within agreements to have a controlling investment, or controlling ability through the structure of it. And so as you were talking about this, I remember thinking that that might be a good example to bring up as well. So can you go into how does that structure work? I mean, the first thing somebody thinks about it, if I'm putting some money into something, like for me not to have ownership of it, like what are the downsides of that? What are the risks and some of those things?
well, that's our biggest obstacle with it, obviously, is my mentality is ownership doesn't matter if I can control it.
Hmm.
That's not how everyone thinks. Right. And so Some people, ownership means a lot. This is not the best plan for somebody that ownership means everything to them. But so basically what we do, we create a partnership between a public charity, which we already have. Nobody's going to be setting up a new charity. That's very cumbersome and takes a lot of time, and nobody wants to do that. Some individuals set up things like private foundations and family foundations, things like that. We can take advantage of all those opportunities, but take away all the headaches of doing that by doing this. We're creating a partnership between this public charity and the client. So we'll use Daniel as an example, right? So we're going to create this partnership where the charity is going to set up the LLC. It's going to own it. It's going to name Daniel as the manager in a manager managed LLC, which is important. And if you're not familiar with it, look at it. There's manager managed and there's member managed. Manager managed is important. It gives all the power to the manager. And we actually name them as manager. They get to be manager for life. There's little things that can happen to have to replace them, but they get to pick who their replacement is. So usually it's their family members. And
So I can put that into my will or something like that.
Well, it doesn't have to go in your will. It goes into the operating agreement.
Okay, operating agreement, perfect.
Will is for ownership.
Oh yeah, okay.
So you can name it, but it's not going to do any good because you don't own it. So, so we name it in the operating agreement. It'll either just be generic and say heirs. It'll be whatever we want it to be. Right? We have an attorney that drafts it, and we then edit it and change whatever terms we want in there. So the manager is going to be the one that has all the day-to-day operating. Think of it as a business. If I own the business and you run the business, I'm not there. You're running the business. You have the autonomy to run the business. Anything major, we just involve in this case, the charity, and make sure the charity approves. The charity is going to approve almost everything because I run the charity. And we're going to have conversations, and we're going to discuss what you guys want to do with your clients, what your clients want to do. I don't know exactly how you all work with everybody, but we're going to have conversations with these people of this is what I want to accomplish, and we're going to talk about how to do it. Right? I can put my planner hat on, and we'll have conversations about buying real estate or buying whatever type of investment and what's the best way to do it. And then we just have the charity sign off on it. We want to show that the charity's in control, even though the charity's not in control. That the manager's in control. We want to, for legal purposes and specifically IRS purposes, we want to make it look like the charity has more control in making decisions because that's beneficial in the end. If anyone
how do you do that? And is there any like gray area or integrity is really important to us.
I mean, gray area comes from what people do.
Right.
So how we do that is we do what I just said. We have the charity sign off on major things. Right? Client puts in $200,000. They want to invest it. They just want to open an investment account. They don't really need the charity to agree to that, but we have the charity sign off on it. So we have documentation in our files to show that the charity was consulted when they opened an investment account with Charles Schwab, working with whoever. And so it's just a piece of paper. It doesn't mean anything, but it means a lot to show that the charity had control. Anytime you're dealing with charity and making donations to charity and getting deductions, control, their big things are control and dominion, which is ownership. So we have that ownership part because they never own the LLC, but it kind of looks like they do, and they kind of act like they do for intensive purposes. But we want to show that there's that control of the manager lies with the charity kind of having oversight. Charity can't tell them what to do. Charity can't demand any money. We have an operating agreement. We have to follow it. And so for them, unless somebody wants to edit it, we make the operating agreement as client friendly as we can. And they get to make all these decisions, which can include paying themselves. So let's say Daniel sets us up, puts in $200,000. Get a $200,000 charitable deduction that goes right on your tax return. The 200,000 sits in the LLC account. Only signer on the account is the client, and then they get to choose how to invest it. So obviously, if they're working with you, you guys are going to have the conversations, and we have no say in that. And we don't really care as the charity. And it gets invested into stocks, bonds, mutual funds, real estate, whatever they want to do, you guys want to do with them. The tax deduction's the big part, depending on what assets go into this. And usually it's 100% of whatever they put in. There are some variables sometimes for things that aren't cash. They can deduct up to 60% of their adjusted gross income, at least currently. And the money stays in that LLC. That's the most important part. The money stays in the LLC until they move it. Right. And so, and even if they invest it, it's still in the LLC's name. And so, but there are ways to do it. If they have a business, we do a lot of stuff with business owners. Sometimes they want to buy a piece of property and they want to own it, use it for their business. They can make loans because that's an investment. We want to be careful so it doesn't look like they're just stealing money from the charity. But there's a lot of options. I don't know all the stuff you guys do, but, and then we just want to make sure that we give something away every year. And so when we do that, you give whatever amount. It's got the minimum requirement is 1% of total value. So we write a check to the charity, include a note saying we'd like you to give this money to our charity, our favorite charity. And so it goes through my charity to their church, their favorite charity, charities, and it ends up there. And we mail it out to them. We mail it out to the client, however they want that done. Charitable giving is vitally important. But it's the minimum requirement again is only 1% a year. So I don't know if that answered the question about what charitable LLC is.
No,
But
I think it did to a high level. And so when you talked about, so what are some of the limitations? Let's say I put in 100,000. One of the things we talk about is the compounding impact of that. So each person is looking at something different of what their investment strategy is and when they're wanting to pull money out and do different things. So let's say I, continue to reinvest that, make it into $1 million. I don't just pull that $1 million out in 1 year, but I could pay myself over that period of time. And then let's say maybe I want to buy a house in the future. I could loan it to myself to then buy the house, like a down payment.
Yeah, you can do almost anything. But again, what we do is we have conversations that include their whole team of advisors, whoever it makes sense to include, which usually includes a CPA, sometimes attorneys, things like that. So one thing to keep in mind is we put in $200,000, you invest it, and it grows to $1 million. That growth is all tax-free because the growth is inside the LLC. The LLC is owned by the charity. So all that any income, most of the time it's unrealized, but any earned income, any investment income, dividend income, whatever it is, gets passed through on paper to the charity. Now, these LLCs usually are what are called single member LLCs. That makes it a disregarded entity, which means it doesn't have to file any tax returns, which is beneficial in most cases as well. Somewhat dependent on what state we use, but most states follow the federal, which says no tax return. So information gets passed to the charity. Once we realize gains, that information passes to the charity as well. So think of it like a retirement account that's not going to be taxable. So it's almost like a Roth IRA.
Right, which is really powerful.
When you do want to access the funds, you don't have to wait till retirement age or any of that stuff. There's different ways to access it should that come in. We don't want this to be the main point to it. Obviously, the main point is charitable, but you can loan money to a business entity or to an individual, including the client. It just, if it's a loan, it's a loan. So which means we have to have a note, we have to have a valid interest rate, we got to make at least interest payments. Interest payments go back to the LLC. Usually
Yeah.
have to go to a business, but it really depends on their situation.
And
Another option is to pay themselves.
which they're taxed on that.
Right. Most people don't do it because it's taxable, and we're trying to reduce taxes, not increase them. But we do have a few people that do it. You're managing a business, you're entitled to get compensated for that. Has to be reasonable, whatever that means. And so again, it's a conversation we have. We don't want somebody having $100,000 and paying themselves $80,000 to manage. That doesn't make any sense. So we want to look like a real business. So we do combinations of things. Now, if you want to go buy a house, my recommendations usually use some of this as a down payment and use the bank's money. But it really depends on the client and their aversion to debt. I'd rather use other people's money and leave my money invested and working for me.
Amen to that.
But not everybody's like that. My guess is your clients probably are, because that's why you're probably working with them. But I have a couple that hate debt. And so they try to pay down their mortgage and bills and all that stuff as fast as they can. My mentality is there's good debt and bad debt. Let's get rid of the bad debt and keep the good debt. And but you know, we go with whatever their philosophy is, not ours.
Right. And I think that's powerful. And I know that people will probably have a lot of questions. We'll definitely save some time for that. And I think one of the things that's powerful, and even looking at like what you've seen with these, movement brands or other companies or people doing things where they have a give back to whatever their business is. This is actually very similar. Like with our Connection Capital and what I do, or what we do with that, we actually have a give back that's already built into what we do for any profits that we bring in. So I think it's interesting. And I think that businesses can be a force for good. So what you're doing is you're creating a entity structure that says, I'm going to go out and build wealth. I'm going to give a portion of that while not taking all my time to charity. Like you could do a gala, or you could turn this money, invest this money that continues to go up 1% or up of that could be more money than spending a bunch of time doing events or doing different campaigns. Because really in that industry, there's events and there's gives. Those are really the two ways. And then the third that I really like is that businesses can utilize what they're doing, the problem that they're solving, and provide a portion of the profits for that. So I do want to make sure we have enough time for questions because it is extensive. And then what I will also do is provide your information for anyone who wants to schedule a one-on-one call with that. So let's open it up to any questions because I want to honor everybody's time. I know Greg could jump more into some of the other things, but I think questions would be great.
So my question would be, when you want to dissolve, like you put in 100,000, you end up with 1 million, and you want to take half of it out.
Okay.
Is that taxed as income when you take that out, or is there a different tax structure for that?
It depends on how you take it out. A lot depends on timing. Most people never close these down. They just keep running. Because it's still a good vehicle for just leaving money sitting and growing for you. Tax free. You've got $1 million, you want to take $500,000 out. Most people are going to take it as a loan. And they're just going to pay interest back. Now, when you pay the interest, you're just paying it back kind of to yourself. Right? It's going back to the LLC where you still have access to it. If you take it out any other way, it's taxable. So most people don't want to pay taxes on it. Again, we do have a few people that pay themselves a salary because they're retired. They sold their businesses, whatever. They want to have some income stream. A lot of times we set it up and put a spouse that didn't work or had less earnings, put them on payroll, let them build up their Social Security a little bit. There's a lot of different ways to do it. But usually we have another business that will loan money to it. Most people, when they do it, they're buying real estate or something like that. And that's more beneficial to own personally than inside the charity, because you get a lot of depreciation and other tax benefits from real estate. So we create a new LLC that's owned personally, and we just loan some money over to it, buy the property. But there are ways to unwind this and close it down. It's got to be well down the future, because the closer to when you set it up and got deductions, the more risk of an audit. And we obviously don't want audits. So most of the time we're 15, 20 years later that we're even talking about it. But most of the time, if we're closing them down, it's because somebody passed away and it passed to the next generation. And then what they do is they actually buy the LLC or buy the assets back from the charity. And that's a non-taxable event. But there's a lot of different ways to do it. So, you don't want to go into it with the idea of getting out of it. You want to go into it with the idea of most people are putting money in every year, getting tax deductions, letting it grow, and then they'll access it when they need to later. Did they answer the question, Gary?
Yeah, somewhat.
Somewhat?
Yeah, it's there's still a lot of questions
Of
about
course.
it's like, because you say there's many ways of getting the money back out.
You can
Besides
borrow it.
taking it and having taxable income, what are some of the other ways that you might be able to take it? Could you do a 1031, something?
Well, there's no need to, because you don't own it. 1031 is really for ownership. But
Yeah.
You can, we can do things similar if they had a piece of property. We do a lot of, use it a lot instead of 1031s, where they have a piece of property that they want to sell. Oh, my light just went off. And instead of doing a 1031, because there's a lot of rules with 1031s, they put the property into the LLC first. Then when they sell it, all the taxable income passes to the charity and the cash stays at the LLC. And then they go buy a property when they're ready to. But then they buy it in their name. Now they get a whole new basis on the new property instead of having to keep the old basis. And the property is owned personally. And they just have a loan back to the LLC. And they pay interest on it. Most of the time, we recommend clients buy an insurance policy when they put assets into this to replace what they're putting in for their family. It's not a requirement unless we want it to be. I have some referrals come from insurance people. Obviously, that's how they get paid. So we make it a requirement, but I don't like doing anything that's a requirement for it. Again, we can do this for business sales, real estate transactions, conversion of qualified money over to non-qualified money. We can use it for almost any taxable event. But getting out of it is, we just have to make sure we do it right. Sometimes we just transfer it to another charity and gives a little more flexibility. We don't have too many people getting out. We have some now that transfer to us from other charities that we're allowing to get out because they're buying the assets or buying the LLCs back from the charity, because we can do it at a discount. But it's harder when it's a gift to a charity to get it back from the charity. There's a lot of rules you have to follow when you're dealing with charity, and we got to make sure they're done right.
So you could use it to finance a business, for instance.
Absolutely.
Yeah.
You loan money to the business. You can have the LLC own some of the business, but that's not usually beneficial, unless the business is being sold. But yeah, you can loan money. It kind of creates almost a family bank, if you wanted to, where you can then loan money to the business. Again, it just has to be a loan.
Yeah, I think the loan dynamic is a big, but not everyone knows that when you loan something to yourself, you're not taxed on that, or loan from a LLC to yourself versus
But
paying yourself. It's just the
but
way it looks a little.
you have to prove it's a loan. You have to have documents.
Correct.
You have to be able to make sure you treated it as a loan. One of the things Hunter Biden got in trouble for was saying he took a loan from a business, but he never paid interest on it and never treated it like a loan. So it's not a loan, it's a payment. You just called it a loan. And so we got to make sure we do it right. And it's
Right. And that,
now off recording, we can have more conversations about the flexibility of loans and things like that as well. So
yeah. And so, to honor everyone's time, I really want to make sure we're covering some of the risks and compliance side of it, because I think the two obstacles are, one is the difference between controlling a LLC and owning an LLC, and the other is I don't want to put myself in a position of an audit, or if an audit did come, I always want to be in integrity. There are strategies within the guardrails, but I really want to be staying within those guardrails. So can you talk about some of the risks and then how we ensure compliance?
truth and honesty is the best defense when dealing with an audit. So doing it for charitable purposes is always going to be the best. The risks are you make a large charitable donation and they audit it. Doesn't happen very often, but if you're dealing with clients that haven't given in the past and now all of a sudden they're giving $500,000 away to a charity, there's a chance. But usually that's just a paper where they just ask for documents. You get a receipt from the charity. We get all the documents that are necessary because it's a real donation. If we use non-cash assets, we get appraisals and tax forms and everything else that all get attached to their tax return and get sent in. There's really not a lot of questions. But the biggest risks are not doing things right, not keeping conversations, not having conversations, not documenting things properly, taking a loan and not documenting it as a loan, just saying it's a loan. Most of the time, they probably wouldn't have a problem doing it because no one's going to ever know. But if they do get audited, you want to have all the documentation done ahead of time. I mean, that to me, in my mind, that's really the risk. Because I know in the client's mind, the risk is they don't own it anymore and they're worried the charity's just going to take the money. That's what the operating agreement's for. We have no ability to do that. We're not going to do that. So we've sued 2 clients over 6 years because they took money and didn't and refused to tell us what they did. And so they took money out, it wasn't a loan, they had to pay taxes and they refused to, and they refused to talk to us. So we had to file a lawsuit. I didn't want to do it, but and they weren't our client. They were donated and transferred over to us. And so there's that risk, but we're not going to do that unless it's drastic.
Right. So somebody's operating outside of the
Technically, that's
guardrails.
embezzlement. Yeah, technically that's embezzlement. So,
Right.
you know, we ended up settling and they just paid the taxes, which is what they should have done at the beginning. But so I don't know. Every client's going to have different perception of what the risks are. In my mind, the biggest risk is audit and them not following instructions. I'm not going to say there's rules because they're not really rules. I'm not going to ever tell somebody what to do. I'm going to give, I put my advisor hat on and I give them advice. And I may give them 2 or 3 or 4 options, and they get to if they pick an option I didn't give them, that there's probably risk involved. And there's going to be risk, and they're going to know what the risks are when they do something, when they make a decision. If the money stays in the LLC and is invested and grows, and they give money away a little bit every year. So a lot of cases, we're just changing how they give. Where instead of giving from their pocket or from their business, they're giving from the LLC. A lot of clients do this for their tithing to their churches. We have a lot of Mormon clients, and they give 10% of their income away every year, and they're doing it through the LLC. And so they're actually saving money on the personal side by giving through the LLC. Now they got a tax deduction in the past, they're not getting it now. But a lot of clients give every year. We have we have about 150 of these LLCs. Some are active. Most of them are active. Some are inactive, and we're working on trying to clean up our books and get rid of probably a third of them. But the active ones, we have a conversation a couple times a year. We ask for account statements. We ask for a balance sheet every year. And that's really our oversight. And we'll look at it. If the value of the account value drops, we'll ask questions. If the account value goes up, we probably don't ask any questions. But if they drop from $1 million to $250,000, we're going to wonder why. And make sure because they were taking money out. But I'd rather catch things ahead of time than wait till somebody gets audited. We've had maybe 3 or 4 audits over 10 years of doing this. And most of those are for something that happened in their business. They get audited for a payroll tax issue in their business, and then it opens up everything else. So.
Okay. That makes sense. Awesome. Well, Greg, I put through your email in there. Marcy also put your office and cell number. I did want to go a little bit into like next steps and pricing, but we don't have, we are at the end of the call. So what I'll let everyone do is set up a call individually with you. Is there a general framework of about what these entities cost and what the minimum normally somebody's putting in, where it financially makes sense before we kind of close it out?
No, and we usually charge 6% of whatever they put in. So it's pretty standard. We have an ongoing where we charge about $2,500 a year if they don't put something in. That's just to kind of cover our time working with them and their advisors for the year. I'm going to say our minimum first deposit into this is about $200,000. It's not really the minimum. We have a minimum fee the first year of $10,000 because we're paying to set up the LLC, do any of the tax documents that are needed. We do make arrangement. We will allow somebody to do less and reduce our fee. We just have them pay to set up the LLC themselves.
Okay.
And so if I'm not out of pocket anything, my minimum fee doesn't really apply. Ongoing future, there is no minimum.
Okay. Awesome.
Most people are putting in 100, 200 plus into this a year.
Yeah.
Otherwise, it's just not, if you're going to put in $20,000 into it, it's really not worth it.
Right.
Headache and everything else, but we can do it.
Yeah. That's what I was getting at, is this where that threshold is. So Greg, I appreciate it. Thank you, everyone. Again, it's really our vision and our goal to help to provide legacy wealth. And this is a fantastic avenue to be able to do that, that has a unique strategy, but is also in integrity, which is always very important to us. So like I said at the beginning, our goal is to help other people make $1 billion. And Greg, thank you for your time. Thank you for your gifting and really helping people in this way. We'll all have the recording in our school community. If you're not in it, we can get you guys the link, and we'll also have Greg's information is right here, and we'll also post that in the community. So thanks, everyone.
Thank you.
Yeah.